China just dropped a 125% tariff on US exports. A shockwave, yes, but not the full story. Because the moment that hit the headlines, something else had already begun. Behind the iron doors of Beijing, a quiet storm was forming. Not a knee-jerk retaliation, but a cold, deliberate recalibration of the global economy. Moves so strategic, so precisely orchestrated that by the time Washington even blinks, it might already be too late. This isn't a trade dispute anymore. This is the beginning of a full-blown decoupling, and it's accelerating fast. April 10th, 2025. China doesn't just slap a tariff on a few goods. They go for the jugular. Automobiles, advanced tech, precision machinery, semiconductor components. All high-value sectors collectively worth over $36 billion in U.S. exports last year. Gone. And the timing? Unmistakable. Just 3 days after President Trump greenlit $88 billion in fresh tariffs targeting Chinese EVs and rare earth minerals. Bloomberg called it a precision strike. But it was more than that. It was a declaration. Wang Yang, senior advisor at Peking University, said it plainly, this is surgical. These are pressure points, and they're politically radioactive back in the U.S. The response was instant. Tesla froze all shipments to China. Deere and Komatsu hemorrhaged $2.1 billion in market value in just 48 hours. Soy futures tanked by 4.3% as whispers of wider retaliation swirled through trading desks. But the real story? It wasn't in the numbers. It was what China did in the shadows. Quietly, methodically, Beijing didn't just retaliate. They pulled a lever. A long-game exit plan already in motion. While the world fixated on tariffs, Beijing was already unwinding the economic architecture tying it to the U.S. By the end of Q1 2025, China had cut its U.S. Treasury holdings to $668.6 billion, a level not seen in 15 years. But that was just phase one. Major state-owned banks, ICBC, China Construction Bank, abruptly froze all new dollar-denominated lending for state-backed projects. Instead, they pivoted hard to RMB and euro-based financing. No press release, no fanfare, just action. Reuters caught the shift, describing it as part of a broader strategic insulation from Western financial exposure. Goldman Sachs economist Maggie Wei didn't mince words. China is engineering a soft but irreversible retreat from the dollar. Preemptively, intentionally. Before the next sanction, not after. Then came the language shift. On April 11th, the Ministry of Commerce declared certain U.S. imports no longer commercially viable. Cold. Bureaucratic, but loaded. That phrasing wasn't just semantic, it was protection. By framing U.S. goods as inefficient, China positioned itself beyond the reach of WTO blowback. At the same time, it sent a blunt message to domestic industries. Cut ties. Days later, BYD scrapped a $500 million deal with a U.S. sensor supplier. No explanation. No renegotiation. Just gone. Analysts like Henry Gao saw the message for what it was. A regulatory signal disguised as market logic. A green light for systemic decoupling. But here's the catch. China's not moving alone. Allies, partners, even fence-sitters are hedging. In March, Germany's BASF inked a $7.2 billion expansion deal in Guangdong, its biggest outside Europe, defying U.S. pressure to curb ties with Beijing. Meanwhile, Saudi Arabia sealed a historic crude oil agreement with OPEC, priced not in dollars, but in digital yuan. For the first time ever, France is lobbying for a BRICS EU dialogue platform. Brazil is pushing Latin America to sync its payment systems with China's. These aren't flukes. They're part of a tectonic shift. A new order is forming, one where Washington no longer holds the pen. Group strategist David Lubin said it outright. The default center of global trade is shifting. If even U.S. allies begin rewriting the rules, the real question becomes, how long until it's America that's on the outside looking in? Washington's go-to weapon, sanctions, is running out of ammo. As of April, the U.S. has sanctioned over 640 Chinese entities. But trade? Still flowing. Exports to ASEAN rose 7.4% in Q1, plugging gaps left by U.S. declines. And the dollar? Its grip is slipping. The yuan now accounts for 6.3% of global cross-border payments through SWIFT, nearly triple its share in 2020. And even the semiconductor blockade is eroding. Huawei's new 7mm chip? Built with a patchwork of Chinese tech and stockpiled Dutch tools, a workaround that proves one thing. The sanctions didn't cripple, they catalyzed. Former U.S. Trade Representative Robert Lighthizer didn't sugarcoat it. We underestimated their ability to adapt. And now Wall Street isn't waiting for a policy response. It's pricing in the fallout. April 10th. The Dow nosedives 1,000 points. $520 billion in market value gone in a day. Tariffs crushed core sectors, agriculture, industrials, EV supply chains. Archer Daniels Midland plummeted 11% in 2 sessions. Deere and Caterpillar warned over 3.2 billion in shipments to China could be derailed. Goldman Sachs slashed its Q2 GDP forecast from 2.3% to 1.5% in a single move. The signs are everywhere. The gears of America's economic machine are grinding. Former Treasury Secretary Larry Summers went live on Bloomberg, issuing a stark warning. Markets are screaming, and the White House isn't listening. This isn't a scuffle. It's an economic firebreak. A chain reaction threatening the very structure of the global system. And here's the tipping point. What happens when corporate America, the same juggernauts that fueled globalization, start demanding peace? While Trump's base clamors for escalation, the ground is shifting. This isn't a battle for headlines, it's a test of endurance. And China is already moving to the next phase. Xi Jinping doesn't want speed. He wants control. Since 2021, China has been quietly expanding domestic chip production by 34% every year. The China Semiconductor Industry Association says it's just the start. Meanwhile, U.S. soybean exports to China have cratered from 32 million metric tons in 2018 to a projected 9.4 million in 2024. Not a blip. A full-scale supply chain redesign. A total reordering of reliance. This isn't retaliation. It's reinvention. A deliberate strategy to untether, reroute, and rebuild a global economic system no longer dependent on American rules. And as the U.S. wrestles with the fallout, with market losses, fractured alliances, and an escalating trade war, China's next move may already be underway. Because in this game, the power doesn't lie with the one who reacts the fastest. It lies with the one who rewrites the rules while everyone else is still playing by the old ones. China had quietly laid the groundwork for something bigger. Something few in the West fully grasped. Long before headlines caught up, Beijing had already inked multi-year grain agreements with Argentina and Kazakhstan. Strategic moves designed not just to stabilize food supplies, but to harden the nation against future disruptions. At the same time, it wasn't just stocking up, it was stockpiling with intention. China's sovereign food reserves surged 18% year over year, not in reaction to a current threat, but in preparation for one looming just over the horizon. It was a quiet act of fortification, subtle but deeply telling. This wasn't just prudent policy. It was preemptive defense against a world shifting rapidly, sometimes violently. Then came April. In what might one day be viewed as a historic inflection point, the People's Bank of China made a rare and deliberate admission. Central Bank Governor Pan Gongxing confirmed that China was actively reconfiguring its foreign reserve portfolio, pulling away from the dollar, reducing its exposure to a currency long synonymous with global dominance. This wasn't just about risk diversification. It was strategic insulation, a calculated effort to shield China from the reach of U.S. monetary influence. Quietly, methodically, the second largest economy in the world was building firewalls, not against warheads but against the dollar itself. Back in the United States, the picture looked very different. Political uncertainty deepened as Trump faced mounting domestic pressure. Inflation expectations ticked upward to 3.1% in April, according to the University of Michigan's Consumer Sentiment Survey. This wasn't just a statistic, it was the signal of a tightening vice around American households. Everyday goods cost more, savings stretched thinner, confidence faltered, and beneath it all, a slow realization was beginning to take shape. Something foundational was breaking. Kevin Rudd, former Australian Prime Minister and China expert, had warned in Foreign Affairs that America misunderstood the tempo of its rival. The real Chinese timeline wasn't geared for the short term, it was anchored in 2050, not 2025. This wasn't a sprint to supremacy. It was a generational test of endurance. The real question wasn't who would hit hardest. It was who would still be standing after the storm. Nowhere were the consequences more immediate than in America's heartland. Farmers, long the quiet strength behind the U.S. economy, were being squeezed from every direction. Tariffs that once seemed like a negotiating tactic had become a crushing weight. The American Farm Bureau projected that $8.6 billion worth of agricultural exports to China, mostly soybeans, corn, and dairy, were at risk by 2025. Yet even that number understated the human cost. In Iowa, the farmer-owned cooperative Landis reported a 37% drop in forward contracts with Chinese buyers that spring. What had once been a reliable export stream was drying up fast, replaced by uncertainty, frustration, and financial strain. The pain was no longer theoretical. It was showing up in bank accounts, in storage silos that stayed full too long, in communities that felt increasingly forgotten. And the tremors didn't stop at the farm. They spread, rippling into retail and beyond. Walmart's CFO, John David Rainey, didn't mince words in the company's April earnings call. Tariffs were driving up input costs, and those costs were now showing up on price tags across the store. Essentials, eggs, milk, bread, diapers were all inching up. The Bureau of Labor Statistics backed it up, reporting a 0.6% jump in food prices just in March. For millions of Americans, the change was immediate. Paychecks didn't stretch as far. Grocery trips required math. This wasn't just economic policy. It was economic pain, lived in real time. But something even bigger was unfolding. The very structure of global trade was beginning to fracture. According to the IMF's April 2025 Global Economic Outlook, the world wasn't operating as one system anymore. Instead, it was splintering, breaking into regional spheres of trust, each one orbiting a new economic axis. China now led one such bloc, a coalition of emerging and mid-sized powers that collectively accounted for 33.6% of global GDP by purchasing power parity. That figure had quietly eclipsed the G7's 29.9%, a once unthinkable milestone that pointed to a new center of gravity in the global economy. The US, still rich, still powerful, found itself increasingly on the outside of this reorganization. Investment flows between the US and China plunged 58% year over year, according to the Rhodium Group. Tech giants like Xiaomi and Huawei, once dependent on US supply chains, had begun building manufacturing bases in Indonesia, Egypt, and Mexico, methodically reducing their exposure to American oversight. The decoupling wasn't just real, it was accelerating, and even Washington began to acknowledge it. Congress debated bills that would bar federal pension funds from investing in Chinese equities. It was a stark move, but also a revealing one. A tacit admission that the divorce was already underway. And yet, despite mounting signs, there was no unified strategy to reverse course. Morgan Stanley's chief global economist, Seth Carpenter, put it plainly. We're no longer watching a decoupling, we're watching a divergence. The US and China weren't just splitting apart economically. They were moving into different realities altogether, each rewriting the rules of engagement. Then came the shot that should have shattered any remaining complacency. On April 5th, China's central bank quietly confirmed it had completed its first major cross-border energy transaction, using the digital Yuan. The deal, worth $2.9 billion, involved a Chinese state-owned energy firm and an undisclosed Middle Eastern supplier. What made the transaction historic was what wasn't used. Not a single US dollar changed hands. This wasn't a pilot project. It wasn't a theoretical test. It was a full-scale, real-world application of China's alternative financial system. Digital, sovereign, and entirely detached from the dollar. If China could replicate this model across platforms like SIPS, BRICS Pay, or emerging oil exchanges in Africa and Latin America, it wouldn't just reduce reliance on the dollar. It would redefine the currency of global trade. It would shift the balance of power not through military might or political treaties, but through infrastructure. Quiet, digital, irreversible. So the question isn't whether Washington will hold its seat at the global table. The question is whether the table itself will still exist in the same form. If trade clears in Yuan, if commodities are priced in currencies outside the dollar, if financial rails are built that no longer pass through New York or London, what role does the US play in that new world? This isn't hypothetical. It's not a think tank scenario or a distant concern for future generations. It's unfolding now in real time. The old world is dying, thread by thread, trade route by trade route, reserve asset by reserve asset. And something else, more regional, more digital, more fragmented, and possibly more volatile, is already taking its place.